For Wall Street Media, this is Nikki. I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
Hey, Nikki.
Hey.
We have Rich Gordon, a super smart, ethical guy who puts a lot of time and thought into exactly this part of the market, and only we have it, and we're sharing it with you.
Yeah,
He's going to talk about Fannie Mae, Freddie, right, and tell you how he thinks he got there and what he thinks of the system that they have in place and what's going to happen. He's a smart guy. Do yourself a favor and listen and learn.
Rich Gordon, fixed income market strategist for Wachovia Securities, WB, discussed the three major factors driving the latest financials rally and the U.S. government's backing of the GSEs.
The dominant theme in the financial markets over the past 2 weeks has been the sharp decline in the price of financial stocks, followed by a powerful short covering rally in those same names. There were three major factors driving the latest rally in financials. First, Treasury Secretary Paulson is orchestrating a package of assistance for the GSEs that includes access to the Fed's discount window and, if they need it, additional lines of credit and capital injections. Second, new SEC rules will stop naked short selling of the GSEs and Wall Street firms. Aggressive short selling contributed to a 25% decline in the value of financial stocks this year and rattled investors' confidence in the stability of these names. Third, over the course of the past week, the four largest banks in the U.S. all announced second quarter earnings that exceeded expectations. In response, investors moved quickly to close out short positions in financial stocks. The chart shows the BKX Regional Bank Index, which had lost almost 45% of its value since the beginning of May. It's rallied sharply since all those announcements were made. Fibonacci analysis shows that bank stock prices have now retraced almost 40% of the recent sell-off. Also, bank CDS spreads have responded positively to the recent news, tightening by 30 basis points over the past 4 trading days. The price action of financial sector stocks and CDS during the sharp downturn in June and July showed how short sellers can punish the weakest names in a vulnerable industry. The extreme volatility and sharp downward direction of the stock prices called into question the viability of some of the companies as going concerns. For me, solvency is a pretty simple concept. A company can either meet its debt obligations as they come due, or it can't. You look at the schedule of maturities, the cash flow of the company, its access to lines of liquidity, and its ability to issue paper. Most bankruptcies are precipitated by a crisis of liquidity, not by a theoretical drop in the asset value of the balance sheet. But obviously, a sharp drop in the value of the assets can trigger a crisis of confidence, which then impairs the access to liquidity. After all, particularly with financials, it really is a confidence game because no financial company, large or small, can survive a run on the bank. In the case of both the GSEs as well as banks with significant exposures to residential mortgages, investors have generally continued to accept the short-term paper, albeit at wider spreads. As a backstop, the GSEs have been given access to the Fed's discount window, meaning they can pledge portions of those enormous mortgage portfolios to access liquidity. Mark-to-market accounting is another way of looking at a company's health, trying to assess the value of both the assets and liabilities of a company. Since assets minus liabilities equals owner's equity, if the theoretical values of the liabilities exceeds the value of the assets, the company is technically insolvent. This analysis is currently being applied to the GSEs and other financial institutions. It's an approach that gives one perspective on the overall health of the company, but it also has some very deep flaws, particularly during periods of high market volatility. For one thing, the assets are being marked at extremely distressed levels that in many cases distort the true economic value of the assets. In the case of some types of mortgage collateral, the difference between the current bid levels and the amount that will eventually be realized on the loans on a cash flow basis is tens of points. Since banks have leverage ratios of more than 10 times, under the mark-to-market approach, the discrepancy implies a severe hit to the equity for those companies most exposed to the collateral. But it doesn't imply a commensurate decline in the economic value of the company. Another thing is that the insolvency stamp ignores the income-generating capabilities of the bank over time. In the case of the GSEs, the business model does provide for a stream of income. So in effect, the mark-to-market approach and insolvency stamp assumes a forced liquidation under distressed conditions and ignores the net present value of the income stream from their businesses. Now I'd like to give some thoughts on the GSEs and their business model. During the past week, we've seen the U.S. government's backing of the GSEs become more explicit than implicit. That's generally good for bondholders and generally bad news for stockholders. It continues a trend toward the partial nationalization of the U.S. finance and mortgage industry that's been operating in the financial space since the Bear Stearns failure in March. For the GSEs, more explicit government support comes with a lot of baggage, including increased regulation, much lower pay for senior leaders, and in all likelihood, much lower balance sheet leverage, which implies lower earnings and slower growth going forward. I've always thought of Fannie Mae and Freddie Mac as two-part businesses. The first part is a mortgage insurer through the guarantee business. The second part is a quasi-government-backed hedge fund that's able to finance itself at more favorable rates than private competitors like banks and S&Ls. Also, because of a strong lobby in Washington, they were allowed to use high leverage and be aggressive in growing their retained portfolios. In the short term, the government is using those retained portfolios as a way to help prop up the mortgage market and keep rates reasonable. You can see in the chart that the growth rate of the GSE mortgage portfolios has increased over the past few months. But I think that over time, the size of these retained portfolios will be substantially reduced because they've grown so big that they pose serious systemic risks, and the government is now on the hook for it. As far as the implications of all this for the mortgage basis, it's not clearly long-term bullish or bearish. Mortgages will lose their buyer of last resort, as well as the appetite of two voracious, quote, hedge fund consumers of the product. But going forward, foreign investors and others that never could get comfortable with the inspecific nature of government support for the GSEs will probably view the paper more favorably from a credit perspective. The short-term effect has been that agency debt spreads have tightened sharply since the government announced measures to support the GSEs, while agency MBS spreads have widened.
Hey, good stuff, man. Super smart, ethical guy. That's who you want to learn from. That's who you want to listen to, right? And another super smart, ethical guy that we have, come back to the site, WSMCO.com, and see Boone Pickens. A genius. We've got his videos, or you can actually see his whole thing if you want to watch the whole hour. And all this is free. I'm doing this. We're trying to help you out here. WSW.com/webcast/Pickens, Pickens, and you can see the whole thing, or you can come back to ours and see the highlight. It's like see the good guys video day.
It's like
right?
Christmas.
Yeah, it is. Christmas in July with Nikki and Tim. All right.
We're here every day at Wall Street Media. You can reach us directly at WSMCO.com.
Thanks, Nikki.
Thank you.